The Hedgeless Horseman here, it's December the 12th, 2022. Markets up, metals down primarily, or overall. Oil, gas up, whatever. There's been a few concepts I've been writing about in an article, and this is just a draft still. I guess I could go over the main points, but you can read this article yourselves when it's actually out. What got me started writing was, thinking about envy. When we see stocks we don't own, let's say, go up, and people celebrating and cheering, especially if it's like a discovery play. Well, went from a pre-discovery play to actually making a discovery, and might be up 100% or whatever, or 200, what have you, or 50, or really anything. It's easy to get jealous, envious, because like right now, for example, I mean the average junior is still very much down from the 2020 high, and a lot of people got in at the 2020 high, so a lot of people are down on your average mining stock, because again, the average mining stock is indeed down. So when you see a stock or a story go up, it's easy to become jealous, etc. But I would just want to point out the fact that, like, I've shown how I'm not really into pre-discovery plays anymore, unless it's a really good case, unless it's, let's say, really cheap, or there's some circumstantial evidence pointing to, yes, this is a way above average chance of success, because otherwise it's like, let's say there's a max 5% chance that a maiden drill campaign will make a major discovery, and if your reward is 100%, that is absolutely not worth it, because if they don't make a discovery, let's say maybe the average sell-off is 50%, and the story is pretty much killed, perhaps. In that case, one would need pretty much a lot higher chance of success than 5%. So I've talked about this before. I'm much more into high probability growth cases, post discoveries, where I see a company having the ability to, let's say, grow at 50% per year. I mean, it will be easier to grow the earlier it is, obviously, but the point is that it's post discovery. So you might be buying in after it has gone up 100%, because again, it's like, since it is so in reality unsound to be big in pre-discovery plays, except if you of course have inside information, typically the best investors, I think, won't really be big in pre-discovery plays. So if you see someone that's sharing, let's say a rise of 200%, and some people who were in before the actual discovery, so they're up 200%, odds are, or one would think, that they do not even have a big position. So let's say you have a 1% position in a pre-discovery stock. It goes up 200%. I mean, that's still just 2% added to the overall portfolio returns. But of course everybody will be happy, yada yada. And the ones, let's say, who are very deep in a pre-discovery play, let's say they have a large amount of their portfolio in a pre-discovery place without any inside information, and they hit it bigly, they're up 200%. I mean, that could have a material impact to the portfolio. I mean, if they have 20% and that goes up 200%, that's obviously 40% added to the portfolio returns, which would be super good. But play that game long enough and said person will end up blowing it all away anyway. Because anyone can get lucky once, let's say. But to continue to bet big on pre-discovery plays, even, I mean, even if it works once, you will be probably more inclined to take on such assay risk, let's say. The largest assay risk you can have maiden drill campaign more times. So I mean, it's like a bad precedent to have been lucky, actually. So I mean, in my opinion, I think one good thing that has happened to me early on was, okay, yeah, I did it that way. I thought you would need to be in pre-discovery to have a 10-bagger, but I think pretty much every pre-discovery play turned out to, well, not perhaps drill dusters, but you know, no super discovery hole. Maybe expectations were too high and they hit something but not enough, you know what I mean. So most of them went down like 50%, and I learned my lesson. I have no problem really with good pre-discovery plays, but like, make sure to keep, in my opinion, a very low portfolio sizing or exposure to that, because vast majority of times a maiden drill campaign will not lead to a maiden discovery. And again, if a maiden discovery is made, it is almost every time more prudent to actually buy in after the 100% pop, etc. You can read this yourself later on. And also, I just wanted to touch on compounding. I mean, this is really, I think, and I need to remind myself of this all the time. Because we are short-term focused, and at least everybody else is short-term focused. So everything we read pretty much on a daily basis, in the forums, on Twitter, etc., everything is short-term focused. Everybody wants to be, you know, correctly quote positioned at all times, meaning the chance of next week being negative in whatever we hold, we want that to be low. Otherwise, we think we should sell. I mean, that's pretty much it. Nobody ever wants to have a downdraft. Nobody wants to have a correction. And it's like, I know people who can't believe why I'm all in all the time and go through a 2-year correction all in. It's like, how on earth can that make sense to not avoid such bear markets, even though I think it makes perfect sense, because at the lows this market becomes so extremely stupid that you will see some stuff that, let's say you have a stock that's down 50%, you find something that is down 80%, really shouldn't be down 80%, and you can just reshuffle, and maybe that one that is minus 80% has an expected return of 400% or whatever. So let's say you sell something that is down 60% and you know, invest in something with a 400% expected return. I mean, you're gonna make your money back and then some. But I also want to touch on, or furthermore on that point, I really think that one should be very much aware of just how incredibly powerful compounding is. And instead of searching for the next 100% pop in the short term, I mean, that almost always leads to wanting to take enormous assay risk, because what companies can go up 100% on you know, on one news release, for example? I mean, that is typically pre-discovery plays. So everybody is hunting for that, you know, 100% tomorrow, let's say, or a 10-bagger in 6 months or whatever, which almost pretty much never happens, and it's mathematically unsound in my opinion. When you really think about it, it's like, I know that it sounds, I mean, if I wrote a case which suggested that, hey, this junior here, let's pretend I could guarantee it would return 100% within 2 years, I doubt anyone at all would be interested in buying that. Even if I could identify 10 juniors that for sure, you know, let's pretend I could know that they would return 100% over 2 years. I doubt anybody would be interested in buying those 10. Even if you started a newsletter like that in this space for the retail audience, it's like guaranteed 100% returns in 2 years. Everybody would be bored to death, because 100% return in 2 years, I mean, people want that within, you know, 3 months at the latest. But when you really think about it, and that's of course why I think the long-term game is the only easy big edge you can have, because when you think about it, again, if you start with $10,000 and quote just average 40% every 12 months, so 40% returns per year, you will have $289,000 in 10 years without any additional deposits. And like I say here, most people scoff at boring cases with, let's say, an easy expected return of 100% over 2 years, yet most can't beat an index. And 40% per year, meaning if you double your portfolio every 2 years, that would handedly beat the market. Handedly. I mean, the stock market averaged 8 to 9% per year. So it's just incredible when you think about it. And I mean, I'm guilty of this as well. When you have a case like, yeah, I actually think this has a very high likelihood of providing, let's say, you know, let's even do better than 2 years, 100% in 1 year. That still is boring. It's just incredible. So I really think that, again, it's our greed and need for instant gratification that is our main enemy, by far. And it's like this, for example. This is Franco-Nevada. If you just looked at this chart, it's like Franco-Nevada gets touted as a, you know, one big success, and you can see the chart here. It looks like, whoa, I mean, hey, this is you know, never-ending uptrend basically. And I recalculated this in terms of compounded annual growth rate. This has, from this point to this, has approximately compounded at an annual rate of 18.65%. Again, and you know, to the point, if somebody says like there is, you guaranteed you will get 18.65% per year in Franco-Nevada, for example, I doubt any retail shareholder really would invest. That would be too low. We're not in this sector we're in this sector to get 10 baggers. Meanwhile, totally forgetting how actually 10 baggers are produced. Even the best, or typically even the best success cases, they become 10 baggers over years. And again, I think a lot of people would be happy with it, or pretty much everybody should be happy with a chart like this if this was the portfolio. And this is still, quote, only 18.65% compounding per year. And of course, I mean, that is easy. Everybody has an easy time looking at a chart like this. Yeah, okay, of course it was a buy at whatever point. But, I mean, was it really? I mean, let's say you sat in the stock here. Or this dip here, or this dip here back to the start, or this, you know, head and shoulders pattern and then a free fall, etc. I mean, there's obviously a lot of big corrections in this chart. I mean, in any given year there's multiple, I would assume, like at least even in a case like Franco-Nevada, like 20% corrections and some major corrections. And then all of a sudden it rips, and a major correction, and rips, and major correction. Again, if you're, how easy is it to trade this? I bet anybody who just bought and hold this did better than anyone else trying to trade this from a total return perspective. That's just my guess. and then I followed up, and you know, to be honest, I think most people's portfolios would look completely different, and their long-term results would be materially better if they would totally focus on probable doublers on a 12 to 40, that's supposed to be 24-month basis. Again, this is something I have to remind myself of. And I am almost certain you can come up with a few names if somebody put a gun to your head and said, pick the 10 juniors you're most confident about, you're most confident would double within 12 months. And again, a 100% return in 2 years is a CAGR of 41.42. Okay, I used 40% in the last example. And again, to show you just how good a doubler every 2 years would be, let's say you only pick stocks that within 2 years from where your average buy price is would double every 2 years. So let's say you start with $10,000, deposit $200 every month. Again, only in cases where you like, on average, these cases are for sure gonna return 100% in 2 years. And let's say you increase that 200 deposit every month by 3% every year, you know, inflation, whatever. Or I mean a salary increase. The ending value would be 47,000. 10,000 initial balance, additional deposits of 27,500 from putting in $200 with a 3% increase every month. So in 10 years you would have 547,000, almost 548. That would look materially better than this chart. This is again 18.65. So yeah, honestly, it's like, I mean, I get, you know, I can get frustrated by Mr. Market being extremely stupid, let's say, that, you know, let's say you're very bullish at play. It's like, it's so obvious it's undervalued. It's like, take I-80 Gold, for example. I mean, probably one of the biggest no-brainers in the junior gold space just a few months ago. It's like, for sure that's gonna go higher, almost guaranteed, and it ended up doing that. But that would be one of those. It's like, and I remember I bought more in the HODL portfolios I manage just because, okay, high chance of success or a high probability of revaluing, margin of safety extreme in my opinion. So there's like, if you just hold that stock, I didn't see how you could actually end up losing money. Sure, you could have price volatility, which we saw, and it became even cheaper. But that's like hands down one of those, you know, yes, 100% within 2 years, that's pretty much a given, and could do way more than that, even in a, especially if we go into some kind of bull market, obviously. But the point is that, yes, I think I-80, etc. And for me personally, again, I put more into the HODL portfolios percentage-wise than my own. Because I still felt that, hey, this is a bit too boring. But that's why I kept, you know, pointing that one out on K Report. Because it's like, I know this is a slam dunk. And I still was not rationally greedy enough, let's say, to take as big of a position as I probably should. I should have bought more just because it was such a slam dunk risk reward. And that, you know, from the bottom is up 100% in way less than 2 years. But it's like, when you see stuff like that, I think you really have to pounce. And I have no problem in cases like that to have. I would be pretty okay with somebody, especially if they didn't have, I don't know, you know, an enormous portfolio. But like, to have 30% in I-80 Gold, you know, a few months ago, I wouldn't be against that at all. because it's like, again, huge margin of safety, very probable 100% return. And again, if you have, let's say you have 20% in such a case, I mean 10%, a 10% uptick is 2% to the portfolio, which is the same as a 1% position, a pre-discovery play going up 200%. I mean, it's much easier, obviously, and much better risk reward, in my opinion, to find the almost, you know, quote, sure bets with a large position than, you know, go big into pre-discovery plays. And if you do, let's say you have a 1% position, even if that goes up 200%, that is still equal to having a 20% position that goes up 10%. And the 20% position is probably much more likely to go up 10% than the 1% position has to go up 200% by definition. I mean, maybe 1 in 100 juniors do that. So it's like, I guess I'm doing this again for myself and others. Like, if we, again, and I've been talking about this for quite some time, but I need to remind myself, like, to have a rolling, let's say 12 to 24 month time frame. The price I'm paying today, what is the company, or first of all, what is the company going to look like in 12 to 24 months? Can I fast forward the tape in my head and see, okay, I expect this news to be out, that news to be out, this and that, and this and that, and this and that. And then, like, okay, the base case after the next 20 news releases, let's say, do I think the value will be up or down? And especially as it relates to price, because obviously there's a bunch of cases out there, HWG Gold, for example, where it's like, right now it's immediately undervalued by, let's say, 100%. And they have growth prospects. So let's say HWG Gold was trading at 500 million. Current value is at least 1 billion. But let's say they could add, who knows, 500 million for the next, over the next 2 years. That is a 200% base case return, which is a lot more than 41% per year, which in itself is insane. So I really think that, again, if we just looked farther ahead, had the infinite patience one is supposed to have, I think everybody's returns would be much better. I actually think I have some work to do on that as well. But of course, it's like, I mean, some strategies are far superior. Let's say, I mean, there's, you know, royalty companies with, you know, perhaps obvious risk reward that, you know, they're selling at cash, etc. So the odds of actually losing money is like slim to none. Still, I am actually prepared to sacrifice some returns for, like, being engaged at least, because otherwise I would simply be too bored. But that is not a good thing. That is a bad thing, that you can't be bored enough to, let's say, have the ultimate risk reward strategy. But I mean, at the same time, I mean, to be a perfectionist, you can't be perfect. And sometimes, I mean, I think there are cases where, yes, they are much more risky, let's say, than a prospect generator selling at cash. But they have enough upside that it's like, you know, whereas a prospect generator probably has a, you know, an almost assured 100% upside. Maybe some of these juniors have like a pretty good shot of 200 to 300% upside. So if you know, risk adjust that based on risk reward, that might be, you know, an even better case actually. So I guess if you're comfortable with a bit more risk, I think you don't need to only be in, again, like buying prospect generators at cash, even though that's probably the safest, best risk reward place you typically can do. I hope some of this made sense, and I urge you to play around with these compound calculators. It's very fun, and it's like nothing brings perspective than, you know, okay, this is, I'm going to get back to this, but nothing brings perspective than when you actually plug in some compounding numbers. And it's like I've stated before, my goal is 50% per year. Not month, not 6 months, per year. Which is almost like a double every 2 years. And that, I think, sounds boring to people. But when you've seen my, you know, chart, for example, especially in the more active portfolio, I mean, I think that has compounded at, I don't know, 67%. I mean, the long-term effects of that, the long-term impact is like obscene. And that's not even from 10 baggers. Because people think, oh, you need 10 baggers to have, you know, 10 bag your portfolio. I mean, that's just not true. Typically, I've been very heavy into cases where I think there's a very high probability of 50 to 100% upside. Anyway, some news. Headwater Gold reacquires the Flint project adjacent to the Delamar project, Idaho. It's kind of a cool news release, or news. I mean, Headwater Gold is super cheap. They have 2 or 4 joint venture projects with Newcrest Gold. So I mean, I think they have a market cap of 15. So there's like dirt cheap. Picking up a project like this again, who are the ones picking this up? Well, it's the same team that got Newcrest interested in 4 of their projects. So you know, they're like super good at picking projects, obviously. So this is, one would guess, a pretty material thing actually, especially for a 15 million market capper. And of course, I mean, I think, what's their name? Well, Delamar, which company, you know? I've talked about them recently. I don't actually remember the name of the... what is their name? Oh, it says here, Integra Resources, right. Integra Resources, which has a multi-million ounce deposit, as you can see. I mean, if somebody buys Integra Resources, or they put in production, whatever, I mean, obviously, if they get something cooking down here, I mean, obviously that's probably going to get mined one day, so it will have value. I mean, this obviously has spillover value from what's going on at Integra, which makes it obviously the threshold for the critical threshold for success is obviously much lower than needing to find a standalone mine. Yeah, I mean, maybe if this wasn't around, they would need, I don't know, 2-3 million ounces or something. But maybe, you know, 500,000 ounces here would be really good, especially if it's high grade, given that this is quite a low grade operation or a resource. And, you know, if you have some high grade to blend into the mix, the economics for this entire project would vastly improve. So this one to keep an eye on. Again, early stage with historic bonanza grade stuff. But again, who knows? Maybe they added. Maybe the risk-adjusted value of this is at least 5 million, perhaps. I don't know. And they have a market cap of 15. So maybe they added 33% in value, with requiring this asset. I doubt, I haven't looked at the share price, but I doubt the market cared too much, even though it should, obviously. And then we have, you know, one of the absolute favorites right now, Magna Mining, intersects 3.8% nickel, 1.8% copper, 0.5 grams per ton platinum, palladium, gold over 10.8 meters, including 6% nickel, 0.3% copper, and 0.7 grams per ton platinum, palladium, gold over 5.8 meters. So this is the first hole of 10 holes. Now I think this is the hole in the guess the assay contest. Obviously, I mean, superb results. I think this 10-meter intercept here is like AU equivalent, excluding recovery loss, etc. It's like 20 grams per ton. So at surface or at face value, that's a 200 gram meter intercepting gold equivalent, even though the recoveries won't be 100%, so it's less than that. But even if you cut that in half, I mean, 10 grams per ton gold over 10.8 meters, or I haven't calculated this, but what could this be? Well, I don't know. 8.3% copper. I don't know. Let's say even higher at least. I mean, most important thing, really good stuff. Very high grade. Very high grade. And they have some schematics as well. Let's say, I think it was from the one, yeah, it hit here. And these are unmined. These are mined, these are unmined stopes. And I don't know if this is actually a true schematic of, you know, the mineralization, because in that case, like hole 5 here looks kind of interesting, given that it seems to be hitting more of this, well, the sulfides here. But I'm not 100% sure on that. How much did it affect the case? Not much, really. I mean, I don't think I would say it's necessarily infill drilling, but it's like at least proof of concept. And again, this is pretty much a permitted project. And this is near surface, or pretty near surface stuff. And they're going to be bulk sampling. I mean, you can just imagine the margins of mining something like this. And Magna is the junior of any nickel juniors in North America, I think, that is closest to production. So, I mean, if they got into production and mines this stuff, this current market cap's gonna look really silly, I think. And there's more stuff to come, obviously. But this again, I mean, honestly, I think this is the best risk-reward case I've seen in years. It's just mind-blowing. I mean, if a grassroots explorer hit grades like this in a, you know, discovery hole, I would bet that would trade at like, I don't know, 30 million. At least, maybe, yeah. And that's without any permits, without a 51.5 ton total resource, etc. I mean, Magna Mining, that's, you know, on the, I see it as the, like the I-80 gold of nickel. It's so absurdly cheap, in my opinion, based on what is already known. The 51 or 50 million ton resource, 2 projects, permitted for a mill, could toll mill, team involved, smart money, etc. I mean, it's just, yeah, ridiculously cheap. I mean, when you think about it, I think I have a chart of, it's like, nickel is around $30,000 per ton, I think, because it's been ramping quite well. When nickel was at 22,000 per ton, Mitsui and Magna agreed to an MOU which put an indicated value on Shakespeare alone at between 64 to 100 million. Shakespeare alone at $22,000 nickel. Nickel is at $30,000 right now. So you can imagine what just the value of Shakespeare is today at today's nickel prices. And then you add the fact that they acquired the Denison project and Green Hill mine, which we see results like this at, and has a almost twice as big of a resource with higher grades. So I mean, I don't think it's a stretch to say that Shakespeare alone is probably right now worth, I don't know, 150 to 200 million, and I think Mitsui would agree. And then you add the Green Hill mine, Denison project, which is even better. And the whole Magna right now has an enterprise value, I think, I don't know, 85 million. I mean, it's just crazy cheap. And that is like, yes, it's frustrating because it's like, how on earth is nobody else seeing this? how on earth can this valuation exist? When you read about, you know, the Canadian government talking about, yeah, we're gonna challenge the US on battery metal production, etc. I mean, you have basically the US and the Canadians now. It's like battling to be building out the infrastructure for battery production, and here you have the most advanced nickel junior in North America, with 2 assets, 1 feasibility study, 2 projects pretty much fully permitted, superb results, 51 million tons of resources, sitting in Sudbury of all places. And it's valued right now below what even the upper limit of Shakespeare alone was valued at, $22,000 nickel. It is just absolutely mind-blowing. But that again goes back to the whole compounding thing. Yes, I find it absolutely ridiculous that it's this cheap still, because my fair value range is up here. But again, it's like, okay, when I take a step back, it's like, okay, we're gonna have a PEA out in late Q1, for example, and there's gonna be a bunch of stuff happening. Maybe toll milling in 12 to 18 months, maybe production in who knows. And what nickel is gonna do, I have no idea. But it's like, yeah, okay, if my goal is 50% per year, and it's supposed to, let's say, its value is supposed to be trading here right now, for example, which is already 100% higher, and that's excluding any additional value creation like exploration success, etc. Yeah, I think this is one of the most solid cases I know of, and I have to keep that in mind when we have these brain dead dips, that this is one of the juniors I think is most likely, let's say, to go up at least 100% over the next 12 months, which would be extreme compounding. 100% because I have a fat stake in Magna, and that's the reason why. Because I think this, again, already based on what is known. I mean, even if they drill dusters, that wouldn't change the fact that what is already there is like a 51 million ton resource. So all the assay risk is like to the upside. So yeah, and again, consider me biased. I have a big position. My family portfolios have a big position in Magna, and they are sponsored. But it's like, yeah, this is probably one of the most no-brainer, brain-dead valued cases I've seen in years, especially with the macro going on in the background. I mean, I can only imagine how many entities would be willing to throw money at Magna, for example. It's like, yeah, we have, you know, critical supply issues. You have the governments actually like, oh, you know, scrambling to take charge in battery production. It's like, what do you need in batteries? Well, nickel. Okay. And nickel is deemed to be a critical mineral in both countries, I think. So it's like, yeah, and you have 2 juniors in all of North America with a feasibility study stage project. And Magna is the most advanced one with the best looking project. So I mean, there's literally, I think, no nickel junior that comes close to the risk reward in Magna. Because yes, you have Talon Metals or whatever they are called. I think they're at, I don't know, 4 or 5 times the valuation, and obviously they're much earlier stage than Magna. So again, from a risk reward margin of safety perspective, I would take Magna hands down. And again, it's like on the notion of compounding. I mean, we know how it is. It's like Snowline topped here, and then it retraced, and all, you know, immediately it's like bitching all over the place. Oh, how dare it not go just straight up? And I mean, even there's some funny people in the forums, like, you know, nefarious entities are dumping and yada yada, this is a pump or whatever, which again always happens. Like, how dare one of the best exploration stories actually take a breather? Because when you think about, okay, let's say this just kept on going. I mean, this was already a, how much was this, like 241%, or let's say from this here 283% in what's that, like, yes, let's say 3 months. I don't know how much that would be. I mean, every 3 months. I mean, that would be like, how much is that? I don't know. Let's say 3,000% per year. Yeah. Okay, you can see the numbers if you would compound at that rate. But that's like, people get pissed off. How can it not just keep on going higher? I mean, it's just ridiculous, the expectations. So even if you take, or let's say from this point here to here where we are now, and yes, it ramped way higher and then it retraced up to, I don't know, 45%. Yeah, heavy retracement, yada yada. Now we're here again, so that's like 154% in, what is that, like, it's like 5 months. I mean, that's absurdly good. 154% every 5 months. Let's say that's 6 months, and let's say, you know, that would be 400% compounded return if it just kept on going like it has. 400%. I mean, in 5 years, if you started with $1,000, that's 30. Wait. Oh, is that so much? Yeah, okay. Yeah, that's like 31 billion. So I hope you get my point. I mean, it's totally rational to expect that, you know, this can just go up. And if you see this and you were a holder, it's like, oh, crap, I made a big mistake. I should have sold the top or whatever. It's like you have no right to complain, even with a ramp like this, and even if you sat through a 45% decline and we're here again. 154% in like less than 6 months, that is absurdly good. That is absurdly good, and that's what I keep talking about, you know, the long-term trend. Because this also had a bunch of corrections and overshot, typically overshot and then corrected hard, etc. But the idea is like, yes, okay, from now, okay, Snowline has a market cap of 470 million, let's say. Okay, do you think it has a shot of doubling that valuation over the next 2 years? That would be a great return from here. But people, it's like some I talk about, it's like they're you know, they want $20, a $20 stock like tomorrow. If it went to $20 and that took 5 years, that would still be worth it. Okay, I don't have that correct. I hope you get what I'm saying. It's like we have absurd expectations, and again, it's like that's what I think one should do. Have a rolling 12 to 24 month time horizon, and in between, it's, I mean, from here, for example, you better believe that the odds of this going up 100% within 2 years is higher than here. But this might still end up being a, let's say, a good buy. Yeah, it needs to hit 8 within 2 years. Is that out of the question? I don't think so. So from that sense, maybe no buy here, even at the top. Maybe this was actually it's going to end up being a good buy. Obviously, the cheaper it is, the easier it is to double the valuation. But that's like the main point. I mean, when you really understand how powerful compounding is, and you look at your juniors that, okay, they are underperformed or not done well in like 1, 2 years, whatever. From this point right now, do you think, you know, it's going to be hard to pull 100% in some of these really cheap juniors? No, and I've shown you the Bear Creek sentiment thing. It's like, I think these juniors can go up to 300% on sentiment alone. And I mean, and we're talking about, you know, a big spectrum here. Let's say, you know, gold prices are flat and Snowline manages to double from here. I mean, if we were in a hot market environment, maybe that's a triple instead, or a quadruple. If it's a bad sentiment environment, maybe it, undershoots $8, for example. But if you have stories where you're like, yeah, this company, I'm pretty sure it's going to return 100%, or let's say 200% in 2 years. That is a superb case, if that has a very high likelihood of happening. If you find a case where, hey, in 1 year or around 1 year from now, I think this has a very high chance of being up 100%, which bores every other person in this space, because again, everybody wants 100% within 3 months, and people can't stand the fact that this doesn't pull that you don't become a billionaire in 5 years, because this just keeps on going up at this compound rate, which is absolutely ridiculous. So if you have cases like that, it's like, again, what makes me chill about Magna? It's like, this is a return here, or a target range, based on what is already known, in my opinion. And if it takes 1 year for the market to actually get its act together and understand just how cheap Magna is, that is a superb return. If I get a, I don't know, 140% return in a year, I would be ecstatic. And there are not too many cases I can say the same, that there's like, yeah, this is a no-brainer 100%. Based on just what is known. Now, a lot of companies I own is like, yeah, there's some, you assume some exploration success. I mean, for example, if Snowline were to start drilling dusters only from here on out, that's not going to get you to 100%. I don't think they will, but you know what I mean. I mean, there's exploration risk in Snowline for sure. And if we go even longer ahead, there's development risk, because there's remote Yukon. Magna doesn't have those problems. Magna pretty much almost have all the permits they need. They already have resources, so even if they drill dusters from here on out, pretty much that would still be cheap. So there's no real downside risk that I can see. That leaves it just with probable upside risk, and that's why I think, again, it's like, do yourself a favor and try, instead of focusing on what will go up 100%, which has a 5% shot of going up 100% within the next month or two, try to pick the companies with like the highest very probable returns you can find. And remember that if you find one that you're almost dead sure is going to return 100% in 2 years, that is a superb case, because that is 41.2% compounding, or 41.42% compounding. And if you could do that with $10,000 invested, and you just deposit $200 every month, and you just could keep on doing that, just keep on being in place, that you think on a 2-year period they're going to double, and you find you have 10-20 companies with those characteristics, that they will on average double every 2 years. In 10 years you'll have $547,800, and you would have crushed everybody. Yeah, pretty much crushed everybody, especially the ones that are going deep in some pre-discovery play and get a 200% return once in every blue moon, and end up blowing themselves up in the other 95 out of 100 that doesn't have a discovery hole. Yeah, some perspective, I hope. Do your own due diligence. This is not investing advice. Consider me biased with every company I talk about. Headwater Gold is a sponsor. Magna is a sponsor. I own shares of both companies. And again, like always, assume I might buy or sell at any point in time. So, do your own due diligence. If a case doesn't make sense to you, you shouldn't buy it, and it shouldn't matter really what I think about a story, because what I think about a story doesn't change a story. But I try to portray it as I see it, while knowing, yes, I'm biased, and especially if I really like a story and I'm in deep, I am more biased. Hopefully that also goes with the case being great, but I can't guarantee that because we have no idea what's going to happen in the future. What we have is risk reward and guesstimates of what the future might hold. Thanks for listening. Hit the thumbs up if you like this stuff. Bye.